Thanks for clicking! Canada's banking regulator, OSFI, is going to be limiting the amount of mortgages that lenders can give to highly indebted borrowers. This according to a new report published by the Globe and Mail.
Now it's time to make a decision.
Indeed, if you've seen a real estate social media post over the past few days or looked anywhere on the media, you'll know that Canada's real estate and mortgage markets are about to change drastically, with OSFI now limiting the number of mortgages that banks can hold, which are 4.5 times a borrower's income. Unless, that is, you do more than just look at the headlines, taking a look at the mortgage math as well as the research to see what the effects of these new caps will be on the real estate market.
I'm pretty busy, so...
Further, as we'll see, while these caps may in fact limit the buying power, the research shows that they could also limit house price growth, which is why the real estate industry may have been so relieved when OSFI put off the implementation of these new restrictions back in October. So what I want to do today is go over some of the changes coming down from OSFI, take a look at some of the research on imposing an LTI ceiling on mortgages, take a look at what that would do to mortgage borrowing in Canada, and then discuss some implications for the real estate market. Speaking of real estate, the end of the month is very fast approaching, and with that, we are expecting March's real estate data coming out from the local boards within the next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these changes. On to the changes. First off, let's be crystal clear about which we are speaking. These new regulations do not apply to insured loans. Those loans which have less than 20% down, where the borrowers pay the mortgage insurance to CMHC, etc. According to CMHC, in the third quarter of 2023, insured loans represented about 28% of all mortgages issued in Canada, so these new regulations would only apply to about 72% of the mortgages. And what exactly are these new regulations coming down from OSFI? As mentioned, according to sources at the banking regulator, banks are going to have to limit the amount of loans they provide to borrowers, which exceed 4.5 times borrowers' income. So, if a borrower's income was $100,000, the maximum amount they could borrow would be 4.5 times, or $450K.
And that's what I'm going to get.
And this isn't the first time that OSFI has considered a change in the loan-to-income regulations. They proposed something very similar in January to last year, just as the banking regulator was expressing a concern over the real estate market. OSFI did end up scrapping those plans last year, much to the relief of the real estate industry, though those plans appear to be back and are set to take effect in 2025.
And then it will be too late.
Yeah, we're going to hear a lot of that. I'm already seeing social media posts saying that buyers had better get into the market now, as affordability is going to get a whole lot worse once these restrictions take place. However, if we look at the research, there is some evidence to suggest that LTI restrictions could in fact slow house price growth. While borrowing power may get worse, that could translate into lower house prices. A study from the European Central Bank found that when Ireland introduced LTI restrictions, borrowers adjusted by lowering their purchase prices. This, in turn, found the paper, helped to cool house prices. And the study in question was looking at Ireland house prices post-2015, right when the country was in the middle of a housing crisis/property bubble. So, given that Ireland's LTI restrictions helped to cool down the housing market, even when Ireland had a supply problem going through a housing crisis, take any supply arguments that you're no doubt going to hear with a grain of salt. So, while we're hearing from the usual suspects that buyers had better buy now or they'll be pushed out of the market by these new regulations, the Irish example at least shows that those new regulations could accompany or even cause house price decreases. But how would this look in the Canadian example? Let's run some numbers, take a look at some potential scenarios, and do our due diligence.
What's that?
Now, I tried running some numbers into the mortgage affordability calculators online using 100K in income and 100K in down payment from TD, CIBC, and RBC, but was given 3 different numbers. As such, let's run the numbers by hand just so we know we're accurate. In Canada, the maximum amount you can spend on principal, interest, taxes, and heat is 39% of your gross income. So long as you have a credit score of 680 or over. If it's less than 680, the maximum amount drops to 35. We're going to use a purchase price of $500K. We'll use RBC's 5-year fixed rate of 5.59, meaning we qualify at 7.59. We'll use a $100K down payment and $100,000 in income, giving us a mortgage payment of $2,789.38. We'll annualize that mortgage payment to $33,472, add in $3,562 for property taxes or $3 3/4% of the purchase price, plus $1,200 for heat, and we get a total of $38,234, or a GDS of 38.3. So, right now, the max borrowing power for a $100,000 income would be $400,000, $50,000 away from that maximum LTI. So, right now at least, these new LTI measures don't change a thing. Borrowers can still borrow just as much as they could prior to their implementation. Now, I know what you're thinking. Well, beyond that, what about when interest rates come down? Let's lower that interest rate down by a percentage, down to 4.59, meaning borrowers qualify at 6.59. We'll adjust the property taxes and increase the down payment, and we get a mortgage amount of $440,000 and a GDS of 38.3. Still not the 4.5 times the $100,000 income, but we're getting very close. But let's go in the complete extreme direction, and we'll bring the qualifying rate all the way down to 5.25, the lowest it can be given the stress test, which, coincidentally, OSFI also said it won't be changing. So let's bump that purchase price up to $650,000. We'll adjust the down payment and taxes accordingly, and we get a mortgage amount of $496,000 with a GDS of 38.509. or $46,000 over and above the 4.5 times limit. So when interest rates do eventually come down, if they come down where we see a 5-year fixed lower than 4.49 all the way down to 3.25, for borrowers with an income of $100,000, their borrowing power could be constricted by up to $46,000. And that's definitely not an inconsequential number. It doesn't change anything right now, but could very well limit borrowing power once rates do come down.
That's 2 months from now.
So, we do have some research saying that these new LTI restrictions could help to limit house price growth. As the math shows, this will constrict buying power when and if rates do come down, though rates are going to have to come down substantially lower than they are right now. With that said, as mentioned, banks will still be able to offer loans at 4.5 times a borrower's income. There will just be a limit on how many of those loans they can hold on their books. And although OSFI has yet to comment on these new changes uncovered by the Globe and Mail, as their sources were not authorized to speak to the news organization, when OSFI first proposed these changes in January of last year, it noted that the limit would allow lenders discretion to underwrite a certain number of loans that exceed a prudent threshold based on lending criteria that may be permissible under the residential mortgage underwriting policies. My guess is the banks will arbitrate that threshold based off credit score and maybe based off liquid assets. How much cash do you have in the bank? Backup cash. So, a number of implications coming from these new restrictions. They're not going to have any effect right now. They really won't come into play until rates drop by at least 1%, but they do have the potential to limit buying power. With that said, and this is the part that needs to be said loudly, the research shows that this could very well limit house price growth as well. It's not as though these new limits come in, house prices continue to skyrocket or even start to skyrocket, and borrowers are just not able to purchase. As the evidence showed in the wake of 2022 when house prices plunged, and the evidence stemming from the case studies, when you limit borrowers' ability to purchase, you also limit purchasing prices. So, do these new limits, these new restrictions mean that first-time homebuyers should run out and buy a house right now? No. We don't know how they're going to be implemented yet, how the banks are going to implement them, and we haven't even heard anything directly from OSFI as of yet. Further, the evidence shows that these new restrictions could actually put downward pressure on prices. As we saw back in October when the real estate industry breathed a sigh of relief when these restrictions didn't come down the pike, the real estate industry wasn't breathing a sigh of relief because they thought prices were now going to come down. In general, what's good for the real estate industry isn't good for first-time homebuyers. With that said, we'll obviously continue to have updates out on these new regulations on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.